Okay. So let me just start off by saying we're not going to have a class meeting next week. I'll be speaking at a graduation ceremony at the very moment when this meeting should be. And so, well, we're not having a meeting, but I will be available throughout the week. I just have that one thing. It just happens to be right at the same time as this. So if you have some specific question come up, don't be afraid to reach out. If you ever look at my additional resource page, those videos, it grew by 4 videos this week because people ask questions, right? That's something I can do. Is a lot of times if someone asks me if they're with a specific problem, is I can try to throw together a video for them, and it depends. But my week is actually my life is slowing down. I teach full time, and we just finished finals week, so although I usually have all these things that come up in the summer. I think I have the summer off, but I usually have plenty of stuff. But anyway, that just means I would have a chance of getting the video put out there for you if you needed it. And so I wanted to, let me share my screen. I want to share this with you. I feel like some people miss this and it's an important thing. Other people are like, yeah, it's there, we know. But in the modules, when you go to the module where the exam is, so into week 5, let's see. Actually, we're not going to, I'm clicking on the wrong thing. This is the exam itself, sorry. Let's see.
Out of curiosity, Brother Fox, you just mentioned week 5. Are we in week 5? I thought we were in week 4.
We are, but the exam's next week, so I wanted to show you.
Oh, got it. Okay.
Where to find the exam study materials.
No. Okay. That got me a little nervous. Thank you.
But now I'm not seeing it. But I do have it in my supplementary stuff too.
Yeah, I was going to say it's in yours. I looked at it today. So
right, but it used to be in the module, so sorry. But if you look
okay.
in my additional study content, so it's not really additional. I just stuck it there because I figure a lot of people look here. But so there's this exam review right here. And this document was not made by me. Okay, it was made by someone in the BYUI accounting department. And as someone who has seen the exam, I will tell you that whoever did this was just seriously looking at the exam and looking at each question and then making like a bullet point that pertained to the question. And so it's a really good study guide. But it's still a lot, right? Because you're like, oh, awesome. So I only have to study, and then it's because when I went to college, I don't know, they didn't give us study guides. They would be like, you'd be like, what's the study guide? They'd be like, your book, right? But now it's the norm to have these. And if you think about it, this is still a lot of material to cover. You're talking, where to go? Yeah, so I just threw exam 1. So what is that? 4 pages of material, but telling you, I think it's pretty good stuff. So I just wanted to make sure you're aware that's there because people miss it, and then they find out like, hey, how come everybody else knew where this study guide was and I didn't? And as I mentioned before, those summary cheat sheets at the end of each chapter are really good. So the format of the exam is it's a multiple choice test. It's not like your homework where you have fill in the worksheet type of stuff. You have to understand the stuff that you would fill in, but it's multiple choice. So it might ask you, given this transaction, what would you do? And they would give you like debit cash or debit accounts receivable or debit, and so you have to know it well enough that you could do it, but it's done in a multiple choice format. I will let you know, and you probably have noticed from like Proctorio and all that the accounting department is pretty uptight about their exam. People ask, but I'll reiterate, they say, can I use scratch paper because the whiteboard feature in Proctorio is terrible? And the answer is yes, you can use scratch paper. I know we talked about that last week too, but just want to reiterate that. And you can use Excel. You just, Proctorio just records your screen, but as long as you have, your Excel is blank when you start it and doesn't have answers or something in it, you're fine. And don't try to put them on like a second or third tab. We're not dumb. All right. I know you guys wouldn't do that anyway, but, like just be honest, and then Proctorio's nothing to worry about. And let me cover that too, because a lot of people are like freaked out by Proctorio. Like it makes them nervous, the idea that like some AI is like watching them, right? And honestly, what it does is it uses your video camera to track your eye movement. And so if you look away for too long, it flags it and says, hey, they're looking away. They could be looking at notes or something. Or if you do something that's obviously like, bringing up extra windows on your screen, it flags it. And if it gets flagged, it gets sent to a real human who looks at it and either says, oh no, it looks like they just, there was no issue there, or there's a possible issue there. And if there's a possible issue, they email the instructor with a link to the video and a timestamp that says, hey, check this out, there's a possible cheating thing. And so like this whole worry about like it could catch me doing normal stuff and think I'm cheating, don't worry about that. Like I have never had anybody ever once that, if it's questionable at all, I'm going to give you the benefit of the doubt and I get to make the ultimate determination. So, it would only be like if someone was blatantly cheating. I'm not telling you then to be sneaky about your cheating. I'm telling you, don't worry about the fact that I know you guys are honest. And when you're being honest, you're not going to, don't worry about like some false positive thing with Proctorio. Don't let it freak you out. Just ignore it and take your exam. I sound like Forrest Gump. That's about all I have to say on that. Questions thus far?
Are we able to use like a blank piece of paper to like write out anything to like keep our math straight?
Yes.
And then calculator, could we use just like a typical calculator like this?
Yes.
Okay.
But not your phone.
Is it closed note?
Yes.
Okay, just wanted to verify. It seemed kind of obvious. I just wanted to, get it from the horse's mouth. So
Yeah, no, it's closed everything. That's I don't make the rules. I honestly, like, I never have once been called upon to do accounting whilst in the middle of like the Mojave Desert with no resources. Like I always have Google at my disposal in real life, but so, but yeah, no, the answer is I don't disagree on this first test where it's like the debits and credits and all those rules. I consider that so foundational, kind of like your times tables when you're a kid, that you really do need to learn them like down pat. But some of the later stuff, I question why we need to memorize it. But the debits and credit rules and being comfortable doing that, I agree wholeheartedly.
okay, thank you.
On the exam, is it gonna be like how we have our quizzes and stuff where we have to manually put stuff in, or is it gonna be, I missed the first part of this meeting, I was in another class, but is it gonna be multiple choice or fill in the blank type questions?
It's multiple choice.
Oh, blessed. Not that it's gonna make it easier, but fill in
And-
blank is so hard.
Well, I will say there are some that are like fill in, a number, but not like, there's nothing that's like on your homeworks where you have like the big worksheet that you have to like build it out. Like sometimes it might be like, they'll give you the info for an adjusting entry and then type in the amount of the adjustment or something like that. So there are some like that. But mostly it's multiple choice. She's like, I take away my blessed. All right. Revoked. Any other questions about the exam? I can't really go into detail about, what's on the exam more than the review. And so I know people want like a full exam, like review or something, but honestly, we have this review and that's about the level of it. But if you had specific questions, of course, I would try to answer them.
Hey, Brother Fox, real quick for you. Is there any way you can tell us like most commonly missed questions on the exam? I saw you were posting like some YouTube videos about it. I was just wondering.
I could tell you the most commonly missed concepts. And so, well, so okay, yeah, there's a couple things. Like I'm surprised by how often people miss what I would consider like just definitional questions. Like it'll be like, which is the best definition for an asset or something like that. And people will be like, "Ooh, I didn't prepare for that. I was thinking numbers so much that I missed that." So like on the study guide, when it says know the components of the fraud triangle, like you know the components of the fraud triangle, like and so believe it or not, those are often missed. Those I call them, like informational or knowledge based rather than like process based questions. But as far as, let's see, I'm just looking real quick. Even though like a lot of people miss questions on like the normal balance type questions, for some reason, like they'll be able to tell you like an asset increases with a debit and decreases with a credit, but then when you say, okay, what's the normal balance of an asset account, they'll be like, oh, I forgot about normal balances. And just remember that the normal balance is the side of the account that increases that account. So for assets, that's a debit. The normal balance is a debit. For liabilities and equity accounts, it's credit. So that gets missed a lot. And then let's see. So I'm trying to remember where this chapter ends and where the next one. So we don't get into adjusting entries yet. So don't worry, Jessica. And then when I said that, you were like,
In that study sheet, it said that, that chapter 2 was a higher majority of the tests exam was about chapter 2. It did say that somewhere in there too.
Well, yeah, I guess so. It's just that like the concepts flow between the two. And what I mean by that is they're both pretty introductory. Yeah, like the thing that's really, really foundational, I mean, there'll be a question about memorizing some term, of course, but the thing that really matters is like, can you do debits and credits? Like that's the thing that's going to carry forward for the rest of this course and into managerial accounting. And so, yeah, expect a lot of questions about can you do a journal entry, right? Can you debit and credit the right accounts given a transaction, or what type of account increases with a debit, or what's the normal balance of this account? So correct. There's a lot of that, which makes sense, right? I mean, it's what we're doing. I don't know, Tyler, did I answer your question?
Oh yeah, you did.
Ish.
You did awesome. Thank you.
All right. Okay. Other questions? I was going to talk a little bit about chapter 11 concepts, just because I think they're confusing. I'll tell you, when I teach this course at my regular college where I teach it all the time, I think it's in chapter 11 for a reason. I teach it way later in the course because it's higher level concepts. And so some of the work will assume you already are really comfortable with debits and credits and stuff. And so it can be a little bit challenging. I will say that they don't go way deep into it in this course. And so they just kind of touch over the concepts. So let's see. Wait, is it 11? Yeah, we're doing this week. Did I just get confused on the chapter? So we're just finishing up 2, right? And then we're going into 11. Yeah, that's what we're transitioning into. Sorry, I looked at it earlier today to double check, and then I was thinking, did we do 12 first? And we did. And 12 is another one that, like, statement of cash flows is a pretty confusing thing. But again, they touch on it pretty lightly, I think. So I'm going to bring up a little PowerPoint here that I stole from the publisher, but then I cut out, they had 90 slides or something crazy. And you're like, no, I refuse to do 90 slides. That would be painful, wouldn't it? Seriously, I just interviewed somebody for a job teaching here at our college, and they were like totally a slide reader. And I was just like, I can't do that to the student. They were actually really great, but I worried about the slide reading. Let's see. I shouldn't mock. We've all been a slide reader at one time or another. All right. It's like ye who was without sin, right? To cast the first, I don't know, little PowerPoint clicker thing, I guess. All right. So let's talk about stock. So stock represents money paid into a business by the owners. Okay. And so when we have like large corporations, or not even large, but just fully incorporated companies, a C corporation, there's lots of rules that regulate how their stock is handled, both from a legal standpoint, but also from an accounting standpoint. And those rules vary by state, which can be frustrating because you'll have one set of rules, in Arizona and another set in Idaho. And so there's some terms that get confusing, and it's important for us to understand them, so that'll help us be able to make our transactions correct. So the first term is what's called par value, and par value is arbitrary. And what I mean by that is it's not, well, it's what arbitrary means, right? Not based on anything. And so when in states that require par value on their stocks, they require in their corporate charter, when you fill out your paperwork, that you name or designate a par value for your stock. It's arbitrary. It doesn't mean anything. Many companies use $1, but it doesn't mean anything. Unfortunately, though, once we record a par value, then when we do our accounting, we have to record our capital stock or our common stock both at the par value and then any money we receive over and above that par value. And so it's a little confusing. Yeah, Alice.
I'm just so confused. If it's an arbitrary amount, why is it even a thing?
Because it is. I don't have a great answer. And some states have done away with it. Okay, it's
like, how did it start? Like, who was like, ah, yes, we should assign a random number to this?
I don't know the history of that.
Okay.
Maybe a research paper, Alice. What do you think? She said, false. I'm not doing that. It really is arbitrary. Okay, so but the market price is the price that people are willing to pay for it at a given moment as it's sold on the open market. And so that's actually driven by those traditional things you learn about in economics, supply and demand. And of course, demand is often based on future expectations and things like that. And so oftentimes we will sell stock or issue stock, I should say, from a company at a price higher than its par value. And so we'll have to record the amount of that issuance that's par value, and then the amount that is paid, they call it paid in capital, in excess of par value. Some states have what they call no par stock. So then we don't have to worry about par value. Others have stated value, which sounds different, but it's pretty much exactly the same thing as par value, except you name a stated value, which is again arbitrary when you issue the stock. This sounds really confusing, but once you figure it out, not too bad. Okay. I know I'm like, it's only a few slides, but then I talk for an hour on each slide. Sorry. It wasn't even an hour. It was like 3 minutes. And half of that was Alice complaining about arbitrariness. All right. You weren't really complaining, Alice. No, you're great. All right. So remember that our stockholders' equity account is made up of in essence, two types of capital. Okay, one is money that we've put into the company as owners, and that's our stock. Okay, so common stock is sometimes called paid in capital. And so the common stock account and the paid in capital in excess of par are these two that represent money put into the business by the owners. And then retained earnings is earned capital, meaning money that the business has made through operating, through selling stuff to people, right? And so that's our retained earnings. All right, so let's take a look at how we have to record the issuance of stock. So this first one, we're actually issuing at par value. So this is Dylan Snowboards. They issued 30,000 shares of $10 par value stock for $30,000. So that means they're issuing it for $10 per share. Issuing just means that the company is selling stock that it owns to investors. Okay. And so when we issue stock at the par value, we just debit cash because we're receiving cash for issuing that stock, and we credit the common stock account. So that's pretty easy. But what happens if we issue stock at what's called a premium? A premium means we're issuing it at a price higher than its par value. So now they're issuing 30,000 shares of $10 par value stock for $12 per share. And so the first thing I would have to do is say 30,000 times 12, and that tells me how much cash I'm getting. So that'll be $360,000 in cash. Then we record the par value of the stock we issued, which is 30,000 times the par value, which is $300,000. And any money we received above that par value is going to be recorded as paid in capital in excess of par value. What I always do, I do it in that order because then I just have to make my journal entry balance, right? So if I know the cash, which is the number of shares times the issue price, and I know the par value, which is the number of shares times the par price, then the difference between those two is going to be the paid in capital in excess of the par value. And so it's, like I said, once you get used to it, you're like, why was that so hard?
Question on
But in the
this.
beginning, it does seem hard. Yeah. Oh, you went, I lost you, Jessica.
So isn't the
My
par value-
question is, is it always going to be like paid in capital of an excess, whether it's going to be par value or stated value, and then is it always going to be common stock afterwards because we're dealing with equity?
So there is another class of stock called preferred stock that it could be, but it would tell you in plain terms it was preferred stock that you were issuing instead of common stock. But yeah, for our purposes here, it's going to be this paid in capital in excess of the par value on the common stock.
Okay, so when you are putting this on the ledger, would you actually write all of those words?
So are you saying you would have on your ledger, you would have an account called common stock, $10
Right.
par value, and you would have an account called paid in capital in excess of par value common stock. That's the name of the account. So yes.
Okay, so just like when we're clicking on our little account box, little down arrow, and we can choose from them, those are the actual account names. We're not like typing that into journal it.
No,
Those are the actual account, like account
Yep.
102 and 105 or whatever.
yeah, like cash is an account name. So is paid in capital in excess of
Okay.
par value common stock.
Okay, thank you for clarifying that for me.
Larry, did you get cut off? I
Par value is just another term for book value.
okay. Except that book value has, when we're talking about an asset, right? Book value has something to do with the cost of an asset.
Correct.
So it is, yeah, it's anyway. Yeah, it's just again, what I would say is don't worry too much about it other than knowing you have to record the transaction at the par value plus any capital received over and above that par value.
Correct.
I don't, there's probably some deeper legal thing that I've never had to deal with in my career, but if you worked in a company where you were dealing with those things, you might, right? That's one of the things about accounting is you tend to like work with the things you work with and then other stuff if the other stuff comes up, you sometimes seek out experts or you do some research. But you tend to end up doing a lot of the same things over and over in a lot of accounting type jobs. And you get really comfortable with those. And then you get some crazy thing and you're like, whoa. Then I pick up my phone and call my friend who does that. Anyway, so let's look at, so here's what our, here's what it would look like on our balance sheet. So this is like a, you'll see common stock and paid in capital in excess of par, the common stock, retained earnings, and then total stockholders equity. So that's just a little stockholders equity section. Again, all paid in capital in excess of par value means is money received from the shareholders that was over and above the par value of the stock. That's all it means. All right. Sometimes we issue stock not for cash. Okay. Like in other words, we get paid for the stock for something else. And so in this case, they're issuing stock, but instead of getting cash, they're getting land for it. You know, in other words, they need land for their business. They know someone who has the land and they say, hey, we can't pay you cash, but we can pay you a certain amount of our stock. So so they agreed to do 4,000 shares, $20 par value stock for land that's valued at $105,000. And so the way they're going to do that is they're going to debit land, right? In other words, before we debited cash, it's some asset going up in exchange for this stock. So you're going to debit land and credit the common stock at its par value. So 4,000 shares times $20 is $80,000. And then the difference is the paid in capital in excess of the par. What's iffy about that in a real life scenario is you could, you know, valuation of land is iffy, right? You could go to a couple of appraisers and hopefully they would be within the ballpark of each other, but occasionally, and in fact, in the market we're in right now, right, land and houses is all over the map, and the map is just high too. So, you know, I just saw in our little town here we had a 1,200 square foot house going for 295,000 or something, and I thought, that seems high for, you know, what I would call a starting out house for a lot of people. But now it's not. It's all the house anybody can afford. At least my income didn't go up by enough to account for the fact that I'd have to pay triple for a house. All right. So companies sometimes pay dividends. So dividends are just a share of the company's retained earnings, typically, that the company is paying out to the shareholders. And so one type of dividend is called a cash dividend, and that's where they're paying it out in cash. So in order to pay a dividend, we've got to have the money to do it. And so that's, you know, that's an important thing. You'll see people with small businesses wanting to take big dividends out of their business, and you're like, you don't have any money. But you know, I do that sometimes too. I like to spend money I don't have, and that's, my wife is good at reminding me that we don't have that. All right. Sometimes they pay a stock dividend. So instead of paying cash out to people, they pay more shares of stock. And so, for example, this is something you could do if you didn't have the cash. You could issue new shares of stock. And so somebody who has, you know, 100 shares will get a, you know, a 5% dividend. And so they'll get 5 extra shares or something like that. And so that's another type of dividend we'll see. This differentiates between a small stock dividend, less than 25% of the previously outstanding shares, which seems like an awful lot, right? If it was 24%, but or a large stock dividend, which is greater than 25%. And then sometimes we have stock splits. Stock splits are different than dividends because when we do a stock split, we're not issuing any new shares. Okay. This is often done by companies who wish to, they kind of want to keep their stock price at a target price. I think there's some thinking that certain, you know, that investors are more interested in stocks in a certain value or price range. Other companies don't believe in that philosophy. You have companies like Berkshire Hathaway that have, you know, a single share of their stock is a couple $100,000. So when a stock split happens, what happens is we actually reduce the par value and the market value of the stock in half if it's a 2-for-1 split. and then double the number of shares. So if I owned 100 shares of a company, and the par value was $20, after the split, I would then have 200 shares at a par value of $10. And so there's no change in the par value, or no change in the overall market value of my investment, but I just have double the number of shares. That's attractive oftentimes to an investor because as the stock grows, I have twice as many shares being impacted. And the most common is what's called a fund split, where they do double the number of shares and half the value. But there are such things as 3-for-1 and 10-for-1 splits that do occur on occasion. And there's such things as reverse splits. Gets really low. I would say don't worry too much about those details, other than recognize that when we do a stock split, we're not issuing new shares of stock. And instead, well, I guess we are issuing. Because we're creating double the number of shares, but there's no cost to the company, right? It's not coming out of our retained earnings or anything like that. Whereas when we do a stock dividend, we've got to pay for those new shares issued with our retained earnings. All right, so here's something that kind of summarizes all this. So when we do a cash dividend, our total assets will decrease because we're paying out cash, and our total stockholders' equity will decrease because we're paying for that cash from our retained earnings. Okay, so retained earnings goes down, and the total and our cash goes down. And then when we do a stock dividend, what's happening is we're not paying any cash, so the assets don't change, but our common stock account increases, and our paid-in capital in excess of par may increase if we're doing this at a price greater than par, and our retained earnings will decrease. So we're issuing stock, but paying for it from our retained earnings. So there'll be no change in overall equity. And then common stock, when we do a large stock dividend, we have that at par value. Okay, so we'll have an increase to our common stock and a decrease to our retained earnings. And finally, on a stock split, there'll be no change to any of those. Issuing new stuff. We're just impacting the price of the stock and then doubling the number of shares. Okay, so I know that what I just did there was like trying to explain a board game to you, right? A board game you've never played. And so it just seems super confusing. And the only thing you can really do is play a few rounds. And then you're like, oh, like that's not as crazy as it sounded. But anyway, so that was a lot of info. Questions? I saw someone pop up on camera that it was not on camera before. That usually means they're about to talk. Or maybe it just was off camera for a minute.
There was a question on the chat, Brother Fox.
Okay. Let's see. All right, so the first question was from Alice. An outstanding share is just one that the business is holding. So no, that's a good question. So outstanding shares are shares that the company has issued, meaning they have put out there for other people to buy. So that's what outstanding means. So when we write our corporate charter up, we authorize a certain number of shares that we could sell. Okay, but we always sell all of them. And so the ones that we actually sell, we're going to call those outstanding shares. Those are ones that are out there for other people. Is that true for everyone else? It helps me determine if it's on my end or if it's on Larry's end. Because I can't fix what's.
I have having a hard time hearing you, Brother Fox.
You have or haven't?
Like that whole part that you were just explaining, it was like you were a robot and cutting in and out. But like right now, it was okay for a second.
Yes, same for me. Well, and then it's
Okay,
back
so
again.
it must be on my end. I don't know what's, let me see. Is it better now? Yes. Okay. I don't know that. So if it's an internet thing, I can't really change it, but if it's, I can wiggle my mic a little and see if that helps. Unfortunately, there's the limits of my technical ability.
Don't wiggle the mic again. That made it way worse.
Okay. So hold very still and talk.
Absolutely.
Okay. I get animated. I apologize. I will try my best. Let's see. And then I have, okay, so good. Thanks, Larry, for bringing that up. It helped me figure out that's something on my end. Maybe my mic's getting old. I could use the one on my camera, but this one seems to usually be better. Okay, so.
Sounds great right now.
All right, I'll just hold very still. The question earlier was, is it always common stock? And the answer is no. Sometimes it's what's called preferred stock. So preferred stock is just a different class of stock. It's got a couple weird rules because preferred makes it sound like it's better in every way, and it is better in some ways. So when you own common stock, that means you get to vote for, am I cutting out again? All right, let me try switching microphones. Let's see if that does better.
Much better.
My old buddy, this microphone has done a lot for me, so I'm sad if it's dying. Anyway, so when you own common stock, a part of being a stockholder is that you're an owner in the company. And so you get to vote for changes in the board of directors of the company. And you get one vote for every share of stock you have, in essence. So, you know, if you have 100 shares of like Microsoft, and I'd have to look it up to see how many they have outstanding, but you would own a tiny, tiny, tiny fraction of Microsoft, but you would get to vote in relation to the number of shares. Same thing when Microsoft issues a dividend, which they're not fond of doing, you would get a proportion of that dividend based on your percentage of ownership of the company. With preferred stock, it's a little different. First of all, preferred stock doesn't get votes the way common stock does. But it's preferred in the sense that it gets its dividends before any of the common stockholders do. So preferred stock gets dividends first, and that's how it's preferred. And typically, and although not always, it has sort of like a set dividend rate. Like, you know, if you have 5% preferred stock, then you'll get a dividend equal to 5% of the par value of the stock. So that's what makes it different, okay? So here's where we're issuing preferred stock. It looks a lot the same way as when we issue common stock. This is, they're issuing 50 shares of $100 par common or preferred stock for $6,000 in cash. So again, 50 shares. Oh no, they're just saying $6,000 total. So we debit cash, 6,000. We take the number of shares times the par value and record that as the preferred stock at par value. And then anything over and above that, in this case, $1,000, we would list as paid in capital in excess of the par value for our preferred stock. So it's very much the same process to record the issuance of preferred stock as it is for common stock. There's how it looks on the stockholders' equity section of a balance sheet. The preferred stock is listed separately from the paid in capital in excess on the preferred stock, and then the common stock, and then so forth. So preferred stock comes in two flavors, major flavors that we'll talk about for this course. One's called cumulative preferred stock, and the other is called non-cumulative. With cumulative preferred stock, cumulative, right, just means things that add up, okay? In essence, with cumulative preferred stock, dividends add up. So if a company doesn't pay dividends one year, then the next year, they will have to pay you last year's dividends and this year's dividends before any dividends can go to the common stockholders. So cumulative stock has what's called dividends in arrears, meaning dividends that were unpaid in previous periods that they would have to pay. So it's kind of like guaranteed dividends as long as the company pays a dividend at some point. If they never pay a dividend, then I guess, you know, in theory, you could end up not collecting that. So just cumulative stock, preferred stock means the dividends add up if they're not paid in a given moment. And then non-cumulative preferred stock doesn't have that feature. So if the company doesn't pay dividends one year, then you don't get dividends, just like a common stockholder. And Jessica, yeah, I saw your question in the chat, and I will try to get through this so that we have time. One more concept, treasury stock. So treasury stock, remember I said that there's authorized shares of stock. That's what our corporate charter says we're allowed to issue. And then there's outstanding shares of stock. That's stock we've issued. Sometimes companies will buy some of that outstanding stock back into the company. They often do that to use it for like employee stock ownership plans, or just because you think about it, the whole reason you issue stock is because you're trying to raise funds for your business. And if you start to be successful, then why have that stock out there for other people to own? You'll buy it back into your own business. So that stock that we have purchased back, that issued stock that we've purchased back, is called treasury stock. And again, it's just money, it's stock that we've purchased back. A couple of things you may have to be able to calculate this chapter. One is called earnings per share, which is the earnings, how much the company made, divided by the number of shares. But the way they do it is you take your net income and you subtract out any preferred dividends, because because you're dividing it by the common shares outstanding, you're also taking out the dividends for preferred stock. So net income divided by net income minus preferred dividends divided by our weighted average common shares outstanding. And to find our average common shares outstanding, typically we just take the number of shares outstanding at the beginning of the period plus the number of shares outstanding at the end of the period and divide by 2. And then the price to earnings ratio, which is just the market price per share divided by the earnings per share. So these ratios get used a lot in investing. I think sometimes in other forms of finance too. These are attempts, at least at a basic level, to understand if a company is market price is how closely related it is to its actual earnings, how high above its actual earnings it's actually trading at the market. Jessica asked the question on the previous one, earnings per share, why do we divide by 2? And it's because we're taking the average. So we added up, we took the beginning average common shares outstanding, the ending, and then divided it by 2 to find an average across. In theory, if you had 8 data points across the period of time, in theory, you could add those 8 up and divide by 8. It's just an average. And the most common way to do it is, because it's the easiest, is just to do the beginning and the end. I see some people taking notes. I don't want to mess you up. All right, and the dividend yield. So our annual cash dividend per share divided by our market value per share. I'm one of those people personally with my own little investments that I like some of mine to be high dividend payers. And so I sometimes look at this dividend yield. It's just like what percentage of the market value of the stock is paid out as a dividend. But to tell the truth, I'm not much of a stock investor. I'm a little chicken. Even when I was a broker for a while, I sold a lot of bonds. I was always working with older people, so I would talk them into buying like municipal bonds back when they were paying 6.5%, and then we would just have the interest pay into like a stock mutual fund. And so the only thing that was taking any market risk was their interest. But I probably could have done better for them if I'd been bolder. But depends, right? When you're 75 years old or 80 years old, you don't want to be that bold. All right. That was a lot of new info. And so my apologies if it was overload. I did get a request from Jessica to look at problem 9 on the chapter 11 quiz access, and then problem 6 if we have time. So let me bring that up. Stop sharing in case I always hate if I leave it up, I'm bound to like click on grades and everybody sees everyone else's grades and they're like, what the, how dare you? So that's why I stopped sharing. It's actually against the law. Did you know that? There's a Educational Privacy Act, and if you share people's private educational information, it's against the law. So I don't want to do that. So let's take a look at 11 quiz access. I'm gonna preview. And I think she said, what was it? Number 9. I know everybody's thinking you're being an overachiever because you're already there, but don't be afraid to be an overachiever.
I was super proud of myself for finishing the chapter 2.
Oh, you know what? I'm not hearing you because when I turned off my headset, I didn't turn on my other speakers. Hold on. Sorry. All right, now I think I can hear you, Laurel.
I just said I was super proud of myself for getting chapter 2 quiz done last night before midnight. That's kind of where I'm at right now.
Yeah, this really is a tread and water sort of class. I mean, a lot of times you're just trying to keep up. All right, so let's take a look at, is this the right one? Who asked for that? Jessica?
Can't see it.
Oh, oh, that's right. I didn't reshare. It's like regifting, resharing. All right, so let's see. We're asked to prepare a classified balance sheet, and classified balance sheets are just a balance sheet that further breaks down our account categories. Okay, so instead of just assets, now we're split into current assets and then plant assets, and sometimes there's other types, but for this one, that's what we have. Liabilities are split into current and long-term liabilities, and then our equity section. What's meant by current assets are assets that are already cash or readily convertible into cash within the next year, or assets that we expect to consume or use up in the next year, like things like prepaid insurance or supplies. So those are things we're actually going to use up. And the same with current liabilities. Those are liabilities that are due within the next year. All right, so really, we're going to start with our current assets. And so, if this were like the good old days and I was doing this on paper, I would actually like write, common stock as an equity account, cash as a asset, and then it's a current asset because it's liquid, it's cash. Equipment is an asset, but it's a plant asset or a long-term asset by its nature. Retained earnings is part of equity. Accounts receivable is a current asset, etc. I would just go down the list and I would categorize those. And so probably when you're first, you're new to doing this, it really does help to kind of like sort them out that way first and then plug them into the balance sheet. So I'm not sure what more to say to talk through it. that, I mean, does just seeing it help, or is there something more?
It
you need?
does. My biggest thing that I was struggling was just dealing with the par values and stuff like that is just difficult to get a handle on.
Okay, so let's just try to talk through that. So if we come up here and we look at our, let's see, so we have common stock, $1,000, and then paid in capital in excess of par value. So it's always going to be laid out with preferred stock first, and then common stock second, and then the regular stock account will be listed above the paid in capital in excess of par for it. So in this case, it gives us all the balances, right? So we just have to put them in there, plug them in, the preferred stock, followed by the paid in capital in excess of par on preferred stock, and the common stock, followed by the paid in capital in excess of par on the common stock, then the retained earnings. And then you'll notice treasury stock is a negative. So treasury stock is a negative to equity. Since equity represents money paid in by the owners or money that we've earned in the form of retained earnings, then treasury stock is stock that we've bought back in. And so it actually reduces our equity. Does that help?
My thing was I was putting all of the paid stuff in at the very end and putting everything else before, but I didn't know it needed to specify with preferred start and then common, like the par value of common stock with underneath common. I didn't know I need to do that.
Okay. And I'm not sure if, like, say you put common stock and then the paid in for common and then preferred, I'm not sure if it would mark it wrong or not. But this is definitely like a standard format that you'll see over and over.
Does it matter if you do common stock first or preferred stock first?
I don't know as far as what McGraw-Hill will accept or not accept off the top of my head. I will tell you that this is a standard. I mean, that's normal to see preferred stock listed first, then common stock.
Okay, I was just curious.
But I don't know if the system will mark you wrong or not. And I know that sounds like I should know that, but it's one of the frustrating things about these systems is you're like, just, like, I understand the concept, but like, just tell me what you want from me, McGraw-Hill, and I'll do it.
Right.
Anyway,
Okay.
and then the other question was number 6.
Treasury was supposed to be negative on equity.
Yes, treasury stock is a negative to equity. So the Sudoku company, oh, those puzzles. They issue 22,000 shares, $8 par value common stock in exchange for land and a building. The land is valued at $234,000, the building at $366,000. Prepare the journal entry. So again, my process for doing these kind of journal entries is always to debit the assets first. So then I know the total amount of assets I'm gaining. So we have 234 for the land, 366 for the building. And then I'll credit the common stock an amount that is the number of shares times the par value per share. So 22,000 times 8 is 176,000. And then my last entry, the paid in capital in excess of par value, is just whatever amount it takes to make my debits balance with my credits, right? So it's the assets I gained for the stock minus the par value of the stock tells me how much I need for my paid in capital in excess. Seems so easy once you've done it like 1,000 times, but it's not. I totally get the first time you're like, I don't know what they want from me here. Well, we're just about out of time. I hope we used it, except for that whole part about like dealing with microphones, but hopefully we used it in a way that was valuable. Any, I guess, parting shots or questions before we say a closing prayer?
Now, this is due on a Wednesday, right? Which is a random, not good day, right?
What is due on a Wednesday?
The test, the final?
The exam is due on a Wednesday, yeah.
Okay.
When does it open?
Okay. So I already opened it. But there's some issue with they didn't put a password in it. So I reached out to the course design people and they're like, oh, yeah. So they're supposed to be fixing it, but it wasn't fixed as of, I looked at it around noon today. I haven't looked at it again. There's certain things that if they change the password in McGraw-Hill, like if I were to just go to McGraw-Hill and put that password in on our side, but then they pushed an update, it would screw everybody up. So I'm like just waiting for them to push the update.
So short answer is nowish. I think it was technically supposed to open on Saturday, but I opened it up early because someone requested, you know, they were doing travel or something and needed to get it done, but then they didn't get to because of the password issue. So
we access the exam through McGraw-Hill, or is it a Canvas thing we do?
So that's a good question. And let me really quick explain it. So because Proctorio doesn't play that well with McGraw-Hill, the way it's set up is you come to the module and then you navigate through the module. Okay. So week 5, why are you doing this, computer? Okay. And you click on the exam here. And then you won't hit preview, you'll hit like start exam. And what it's going to do is bring up this little quiz in Proctorio. And then you scroll down here and you have to leave Proctorio open. These instructions will tell you this very specifically, how to do it, okay? Right here. And then you click on this link, and here's where the password should be, but it's not. You click on this link, and that will open up the exam in McGraw-Hill, and then you put in this password. But they want you to leave this open because that's how Proctorio is going to see your screen. Then at the end of all that, you close your McGraw-Hill exam, and you come in here, and I confirm I followed the honor code, hit true, and you submit this little quiz. So that's the process. Again, they have instructions on how to do it, but still every time it throws people off the first time. So I'm glad you asked that.
It's important too, if it happens to kick you out while you're taking the test, that you get back in touch with them, the Proctorio people, to get back into the exam. And they're very, very helpful about getting you back in, because I had problems last semester and you kicked me out a couple times and they were able to get me back into it.
Yeah, so this info right here
absolutely
is like, what he's saying is true. Proctorio is like, usually when you're like, oh, I have to call somebody's support desk, that's going to be horrible. Theirs is actually pretty darn good. So anyway, okay, so we're out of time. I've got another group coming in. Can we get, sorry to rush, but can we get a closing prayer?
Send out an announcement when that exam password is fixed.
I will, yes.
Thank you. And I can say the prayer if you want.
That would be terrific.
Okay. Dear Father, we thank thee so much for the opportunity that we had to be able to gather today as a class and to go over some concepts in chapter 11, and hopefully that we gained more understanding. And please bless us all as we prepare for exam 1, that we will be able to understand the material and do well on the exam. And we thank you for everything that was done for us. And we say these things in the name of Christ. Amen.
Amen. Thank you. So for those of you who are in Accounting 101, if you just popped in, I'm going to be closing this meeting so I can start the new one. So sorry if that happens to you and you were here for the next meeting. Have a good night, everybody.
Thank you.
Thanks. Bye-bye.